Good afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm a co-portfolio manager on Westwood Select Equity and Dividend Select Strategies. Today, we wanted to take this opportunity to talk about what's going on in the energy market, what has caused the big hike in prices, and what is our outlook. For that, we have our two very talented colleagues joining us on the call as well. We have Bill Costello, who is the director of equity portfolios here at Westwood, and Matt Na, who is a senior research analyst. Between the two of them, they have combined 44 years of experience covering the energy sector. Hi, Bill and Matt, how are you doing?
Good, thanks, Maria. Thank you for having us.
Yeah, thank you.
Super excited to have both of you. So I'm going to ask a list of questions, and they are for both of you. So please feel free to jump in. So let's get started. I'm sure we all recall the day of April 2020 when the oil prices became negative for a bit. And late last week, and actually it was early last week, oil prices actually turned $130 per barrel. We have also seen the energy sector return more than 232% over this time period. So can you please recap for us what caused this massive recovery in the oil prices and where do we go from here?
Certainly, I can kick it off, and Matt can certainly chime in. You know, basically, I think what happened is as we went into 2020, we just had a totally unprecedented demand loss. I know during COVID, we seem to use that word unprecedented many, many times in many occasions, but there's no time in the history of the world where we lost 20 million barrels of demand, which is about 20% of daily use of oil in a very short period of time. And so that's what caused the prices to go negative. And it took a while for the supply function to adjust to these lower demand levels to try to balance the market. And as the demand has come back, which today it is back above those levels and above the 2019 levels, that's what's really tightened the market. And supply has been slow to respond to that through a combination of factors, lack of investment in the industry, and certainly the actions of the OPEC plus countries in restraining the supply a bit. I think that explains the majority of how that happened and where we are today.
And just to follow up on that, just to dig deeper, can you please help us understand the supply side of the oil market and what's going on there?
Certainly, really you can frame it in a few broad brushes. If you look at the, call it 100 million, 102 million barrels per day of supply, the United States is actually the largest producer of oil. And we had seen the lack of investment and seen our production drop by over 2 million barrels a day. It's slowly coming back, but that takes time. And there's a couple factors involved. One is the willingness of companies to spend the capex to grow the production. They have gotten a new disciplined focus where their shareholders have told them that over time they haven't distributed enough capital back to the shareholders. They've put too much of it in the ground. So they're growing at much slower rates than they were a couple of years ago. The other, two big areas of supply are Saudi Arabia and Russia, which both produce in the neighborhood of 10 to 11 million barrels a day. So if you add up all those three countries, that's a third of where the supply comes from. And Russia has had challenges growing their production, not to mention what's going to happen now that they've gotten into a war, but even before that. And Saudi Arabia probably has about 2.5 million barrels of spare capacity that they could produce if they wanted. But the OPEC plus nations, which are about 40% of production, a little bit more than that, had cut off the supplies or constricted the supplies, and they've been bringing them back at a measured pace to support the oil price. So that's really the big pockets of supply. If you look around the other parts of the world, you've had countries that have had issues. Libya's supply has been affected because of turmoil in that country. Venezuela, similar. They were both bigger producers 10 years ago than they are today. They had tripled their production. You've had other African countries like Angola, which for a while there had been a growth engine. They've plateaued and actually are in decline. You've had Nigeria, which has had trouble growing their production through both natural field declines that they haven't been able to offset, and then also politics in the country. So there's not much spare supply capacity in the world. And as the demand grows, we need more and more supply.
I guess moving forward as well, there's, the industry is facing supply chain issues, particularly around steel and labor. So going forward, trying to grow production is going to be a difficult scenario for these producers.
So what do you think is the role of shale in all of this?
It's definitely a big part of the component that will need to fill the demand hole. We think this year U.S. shale supply will grow actually in the neighborhood of 700,000 to 1 million barrels a day on average throughout the year. I think you will need that pace going forward just to meet the demand that's out there. Well, one of the things that I think people don't have a very good understanding of, especially the political aspect of our country and the politicians, I think they think that you can just turn a spigot and oil will all of a sudden come onto the market and be produced, when they don't understand the supply constraints or the difficulties of doing it. If you're out in the Permian, for instance, which is where half the rigs are drilling in America and where it's the most prolific oil province we have, if a company were to develop a pad of production, they'd have to, first of all, find a rig. And while we do have extra rigs, they might not be in the best working condition. They would have to find a crew to run that rig, which labor shortages we've seen all across the country, including the oil industry. Hard to find qualified labor, hard to secure the steel and the pipe that you need to drill a well. And then you would not do an inefficient development. You wouldn't just drill one well. You'd probably drill 6 to 8 on a pad. And each of those wells would take 20 to 25 days to actually be drilled. And then you have to do something that's called the completion technique, which is fracking the well. And typically the better, more efficient operators have decided is you will drill the wells first, rig leaves the pad, on comes the completion crew, and then you complete all those wells simultaneously or back to back. But each one takes another 2 to 3 days. So even if you decided today that you wanted to bring oil to the market, that oil is not going to hit the market for at least 150 days. And I don't think people understand that dynamic. They think we can just snap our fingers and the oil will be here, next Monday morning, when that in fact is not the case. So the shale industry will respond and will grow production, but it takes more time than people appreciate.
That is super helpful. And I think every time the gas prices go up on the, at the gas station, everybody's like, we have so much shale, why don't we just start producing? But there's, as you mentioned, there are about 150-day delay or 5 months worth of delay before it can actually become operational. So let's shift our focus on the demand side. Of course, as you mentioned earlier, we saw this massive demand destruction during COVID, and since then it has started to recover. So what do you think where do we go from here? And what is your outlook for the demand side?
As we look into 2022, we think demand globally will be somewhere in the neighborhood of 101 to 102 million barrels per day. It's really driven by a few factors. The United States, for one, we're the largest consumer of oil. We consume about 20, 21 million barrels a day. And actually, our demand has been very strong this year. Our economy obviously rebounded very well from COVID. And I think some of the changes that transpired during COVID, whether it was our mode of transportation or whatever, has increased the consumption. Gasoline consumption is very big. That's the biggest part of that 22 million. I think that's really helped drive the global growth. Obviously, China is a very big piece. They're the second largest consumer, and their growth has historically been much faster than ours and of most developed countries. So I think if you look at the three biggest consumers, they all are growing: the US, China, and India. You've got some other places that are in decline, like Europe. And I think one of the hidden factors in demand that it's hard to quantify, because the United States puts out very good detailed statistics. But if you look at some of the other places in the world, specifically Middle East and Africa, there's not really good demand numbers there. And usually when you see a tight market and you can't figure out where that stronger demand is coming from, it's usually coming from a place like that. Now, of course, as we look through the rest of the year, there's going to be obviously some puts and takes in demand. We have no idea what this Russia-Ukraine situation is going to do to demand. It will definitely dampen it to some degree. We don't know what the sanctions that we've put on Russia will do. We would assume that would hurt their economy, which would constrict their demand. Not that they're necessarily a big demand driver, but everything is on the margin in the oil industry. And so there's a lot of puts and takes, but we think over time, demand will continue to grow. If you use a rule of thumb, whatever you would think global GDP is, oil demand has historically tracked at about 0.3. So if we have an economy growing 3 to 4%, we should need about another million barrels, which would be a 1% compounded annual growth rate in demand. So right now, it looks like demand's stronger than that. This year is going to be a larger number, but as we look out into the future, we can see that continued demand. And despite the green movement and the movement to electric vehicles, there's a lot of offsets, and that'll take time to flow through the system. So we haven't seen peak demand yet.
That is super interesting to hear. Thank you so much. So let's talk about OPEC Plus. As I mentioned earlier, oil prices touched $130 per barrel last week. Since then, they have retreated. So what do you think is the likelihood of OPEC Plus deciding to increase production? Because there have been some rumors recently that they might agree to increasing production. What is your outlook on that?
We would say it's going to happen, but increasing demand, increasing supply to meet this demand is not going to happen in that type of functionality, if you will. They have a plan in place where they're going to bring back 400,000 barrels each month through the end of September, and that'll get them to where they were before they restricted and before the COVID situation. They should continue down that path without any problem. But additional supplies beyond that will be hard to bring to the market. There's really, if you look at the countries involved, there's probably only 3 countries that have the type of spare demand or spare supply that they could bring to the market in a short period of time. That would be like the Saudi Arabias of the world, United Arab Emirates, and maybe a few others. There's some wild cards where demand could be, or supply could be brought to the market. Iran would be one of them. That's obviously a political situation that would have to be sorted out better than it is. But we don't see them like bringing a lot of supply on to ease the pain and to lower the prices in the short term. But we do think they'll continue on their orderly plan.
I think it'd be a good place to mention, the uncertainty around the China lockdowns related to COVID gives OPEC a little bit of a cover to kind of keep a measured approach as far as bring supply onto the market as well.
Super helpful. So let's shift our focus from oil to natural gas, Matt, and I think this is your area of expertise as well. So what is our outlook for natural gas and what kind of opportunities are you seeing there?
Yeah, I'll just give you a little bit of background. So natural gas, seen as a more cleaner fuel, has replaced coal generally in a generation stack. Natural gas is seen to kind of be a bridge fuel as we transition to kind of greater usage of renewables for electric generation. Post-transition, I'd say natural gas is here to stay. It'll serve as a backup generation fuel and also kind of satisfy peak demand needs, in the winter months particularly. I'd say pre-war pricing was heavily dependent on weather patterns. So cold seasonal winters would indicate price increases or price spikes. We generally view the natural gas market as more balanced. The inventory situation in the U.S. was in good shape. We were right in line with the 5-year average on that front. This past winter, though, I'd kind of highlight a few things that drove the higher natural gas prices. So in Europe in particular, there was an unprecedented lack of wind generation. So their renewable generation stack was not performing as expected. And then the cold winter in Europe as well increased demand for natural gas. So this kind of weather-driven demand combined with supply concerns now with the Ukraine-Russia war dramatically increased prices temporarily. Longer term, we see a pretty favorable environment for U.S. natural gas industry. From strong international demand, strong demand in Asia in particular, and then Europe now is going to look to diversify away from their reliance on Russian natural gas. So the European Union is now looking to replace roughly about 70% of Russian gas imports. That currently represents that amount of gas represents roughly a third of current U.S. export capacity. To give you a sense of how much gas they need to replace that Russian reliance on.
Super helpful. Thank you so much. So let's talk about the broader implications of higher oil and gas prices. I read somewhere, and I'm sure a lot of our clients have read this as well, that every time we have seen the sudden spike in oil prices, whether it was 2008 or in 90s, it's almost always led to a recession. So now that we have seen this huge jump in oil prices, what do you think is the likelihood of U.S. economy entering into a recession on account of higher oil and gas prices?
It's not out of the realm of possibility. To your point, in the past, the two have coincided together. But typically, and if you look back at that point in time, the share of the consumer's wallet that oil really took up was a lot higher. Today, it's down around 4%. maybe a little bit under. I think I saw 3.9. And back then it was closer to 7 to 8%. So the impact isn't as hard on the consumer as it was in the other time frames, but you really can't rule out that possibility. Obviously, nobody likes to go fill up the pump or at the pump or heat their house with the prices we're seeing now. So it's definitely a distinct possibility, but I would say the odds are much lower that the oil price itself would cause our recession, where in the past it may have been a more direct correlation.
That makes a lot of sense. I think as you mentioned, that our pocket and our spending as a consumer, as average consumer, has changed a lot, and our dependence on oil prices have also decreased. So these are all the questions I had. Thank you so much, Bill and Matt, for your time today. And thank you everyone so much for joining us today. Please feel free to reach out to your advisor if you have any questions. We hope you have a wonderful rest of the day. Bye-bye.